Is it a good time to buy in Sandy, Utah right now? Well, if you ask a general real estate agent, answer is always a predictable, robotic, yes, it's always a great time to buy. Because if they don't sell you a house, they don't pay their car lease. But we don't do sales pitches on this channel. We perform market autopsies. Here is the blunt forensic truth for mid-2026. If you are an out-of-state relocation buyer, an equity-rich move-up client, or a long-term investor, Sandy is offering one of the most strategic windows of opportunity that we have seen in many years. Prices have subtly softened from their frothy pandemic peaks, while our underlying economic fundamentals remain absolutely bulletproof. But hear me clearly. If you are a highly payment-sensitive buyer waiting for a dramatic real estate crash to rescue you, or praying for mortgage rates to magically drop back to 3% before you pull the trigger, buying right now is a terrible move that will leave you financially exposed. Today, we are cutting through the noise, and I'm going to break down the actual unvarnished numbers from Redfin, Zillow, and our local MLS data. We are going to look at the exact mechanics of why Sandy is currently a buy for the right client profile, and the exact red flags that mean you should walk away and keep renting. Let's look at the data, because numbers don't have emotions and they don't care about headlines. The data tells a fascinating story of a highly localized market transition. If you look at Zillow, a typical Sandy home value is hovering right now at around $650,000 to $672,000. On paper, that looks like a modest 2% increase year over year. But when you dig deeper into Redfin's actual closing data, the median sales price recently dropped to $634,000. That's nearly a 3.5% decline year over year, with a median price per square foot tracking right around $265. In fact, if you look at the local Salt Lake market sub-reports, Sandy is one of the very few high-demand submarkets along the Wasatch Front, showing a distinct localized median price pullback while the rest of the state is still inching upward. What does that actually mean for you? It means the dumb money frenzy is officially over. Look at the market balance. In 2021 and 2022, homes were selling in seconds with waived inspections and buyers paying way above appraisal values just to win. Right now, median days on market has stretched out to near 40 days, and in some micro pockets, it's actually pushing 60 days. Even more telling, homes are closing on average at least 1% below list price, with over 53% of transactions closing under asking price. Realtor.com has officially categorized parts of Sandy as entering a mild buyer's market. We haven't seen that terminology used in Salt Lake County in a long time. The leverage has shifted, but only if you know how to wield it. To understand why this pullback is an opportunity and not a red flag, you have to look at the anatomy of Sandy itself. Why are prices dipping here while long-term demand is solid? Because Sandy is a mature, fully land-bound city. We can't sprawl outward like Harriman or Eagle Mountain. We are boxed in by the mountains and neighboring cities. When a market experiences a rate shock like we've seen, newer, commoditized suburbs on the fringes get hit with high inventory because developers keep building. In Sandy, our inventory is structurally constrained. Right now, we only have about 2 months of supply of available inventory. That means we are still technically in a supply-deprived environment. The small price dip we have seen isn't a structural collapse. It is a volatility discount caused by uninspired sellers trying to offload outdated 1980s and 1990s housing stock at peak prices and pick year 2026 buyers saying, no, thank you. Think about the infrastructure. While fringe suburbs are fighting for new lanes on the highway, Sandy is actively absorbing billions of dollars in infrastructure upgrades. Look at the Cairns Master Plan, a 1,000-acre revitalization project transforming Sandy's urban core into a walkable, multimodal downtown center. From high-density luxury residential projects like Centennial Village to the massive expansion around America First Field. The city is literally banking on long-term appreciation. You are buying into a city that is fundamentally re-engineering its tax base to win over the next 20 years. If you fit the profile for an equity-rich buyer, a relocation client with cash from a high-tax state, or a legacy move-up buyer, here's how you weaponize this 2026 market window. First, you aren't competing with the masses anymore. Bidding wars have evaporated. When a house sits past 30 days, a psychological shift happens to a seller. They go from arrogant to anxious, and that is where we step in. Instead of asking for basic price drops, we are using this market softness to negotiate for permanent interest rate buydowns and substantial inspection credits. I recently had a client look at a home on the East Bench that needed a new roof and an HVAC update. In 2022, that buyer would have had to swallow that entire cost. In today's market, we forensically use the inspection report to claw back $25,000 in seller-paid closing concessions, effectively lowering their out-of-pocket cash and buying their interest rate down a full point. Second, the macro risk of a housing crash here is incredibly low. State and local forecasts through 2027 point towards stable, positive population growth and incredibly tight housing supply. Your main risk in Sandy right now isn't a sudden 20% price collapse. Your risk is picking the wrong micro location, buying into a traffic bottleneck, an unplowed priority 3 street, or low elevation inversion pocket, and underperforming the rest of the city. Well, if you are a highly payment sensitive and rate anchored, step away from the market. With 30-year fixed rates stubbornly hovering in the mid 6% range, trying to force a high interest mortgage into a razor thin monthly budget will make your life miserable. If you are sitting on the sidelines praying for rates to magically drop to 3 or 4% before you buy, understand the structural trap of that logic. The moment rates drop, the sidelines will empty. A flood of sideline buyers will rush back into the market and drive prices up $50,000 to $100,000. You'll save a few $100 on the interest payment, but you'll actually take on that extra $100,000 in permanent principal debt. Similarly, if you are a spectator looking for a quick cosmetic flip, Sandy is highly dangerous right now. Picky buyers and flat short-term appreciation means uninspired, cheap flips are sitting on the market and rotting. The days of easy money are gone. You should buy now in Sandy if you plan to hold the asset for at least 5 to 7 years, allowing the structural appreciation of the valley to compound. You care as much about the micro-location lifestyle elements, like elevation to stay out of the winter inversion and proximity to the trax lines, as you do about the sticker price. You want to use the current market softness to bully anxious sellers into fixing structural defects and buying down your mortgage rate. And you should rent or pause if your primary concern is squeezing out the absolute lowest possible monthly payment, forcing you to overextend your debt-to-income ratio. You are buying completely blind without knowing the clear physical differences between the East Bench, the Cairns core, or the West Side commute traps. The reality of the 2026 Sandy housing market is simple. It's a premier, data-driven buyer's market. The market isn't crashing, it's mature. And you win in a market by being an absolute sniper with your micro-location and your contractual negotiations. If you want a pointed, customized strategy, whether you're relocating from out of state, moving up into a larger legacy home on the bench, or looking for a defensive investment property, let's look at the actual comps on your specific block. Simply text the word Sandy to this number, and I'll send you my private 2026 Sandy micro velocity forecast, complete with pricing adjustments by zip code, local snowplow priority grids, and our active zoning roadmap. I'm Michael Walters, and I grew up here. I live here, and I don't just list homes. I engineer them to win. Let's look at the data, and I'll see you in the neighborhood.